Financial Freedom Show. My name is Rob Berger. Yes, this is a live video. I've started doing a lot of my videos live recently. Part of it is so that the folks that can join, happy to answer questions about the topic of the video at the end. And so if you're in the chat, maybe you can give me a thumbs up that everything is working well and that the show is actually live. Today, we're going to talk about a way to track your investments that I have actually never tracked my investments this way. And I'm going to start doing it. And there's a specific reason why. And as I want to share that with you and some tools that help you do that. So normally when we think about tracking investments, we think about the value. What's the value of our ETFs, mutual funds, stocks, bonds. And that's certainly an important thing to track. And I'm not suggesting we stop doing that. But I've now come to the belief that there's a lot of value in tracking the dividends that we earn. Now that may come as a surprise, I guess, and I should say interest from bonds as well, but I'm more focused on the dividends in this video for the most part, but basically the same concept. And that may come as a surprise to many of you because I'm not a big fan of chasing dividends. I think they're an important part of the returns that we receive, but I don't think that one investment's better than another simply because the dividend yield is higher. But I do think there's a lot of value to tracking dividends. Why do I think that? Well, let me tell you a story. Back in the 1800s, there was a company, Jeffrey and Company, that was founded. It ended up getting into, I think, coal mining. And, it was a successful business. But in the 1900s, in the 20th century, it transitioned from an operating company to basically an investment company. And the idea was the owners had made a lot of money. And they wanted to manage that money in a way that would benefit the family. And of course, as generations came and went, the family grew. And so the idea was we want to protect the assets. It started investing, and the question came up: well, how much money can we give to family members each year without depleting the money that we have? We don't want to eventually go broke. We'd like this to last forever. You can think about kind of like a retirement. We might think about a 30-year retirement. Well, imagine if your retirement was 1,000 years. That's kind of what they had in mind. In that sense, it was very similar to what endowments do. You have the Yale endowment or Harvard endowment. They're not, a 30-year proposition. They want to kind of last forever. And so they have this. It's the same kind of issue. How much money can we give out to, in that case, education, and but without depleting the endowment and running out of money? And so they figured it out. And here's the company. I'll leave links to this below the video. Here's actually the website of the company. It's not very fancy. And it's actually headquartered in my hometown, Columbus, Ohio. One of the gentlemen involved with this company, Jim Garland, has written a lot about how they've managed these investments. One of those papers is right here. He's a chartered financial analyst. Here he is. Again, I will leave a link to this paper below the video. So this paper talks a lot about how they manage that. And the reason I bring this up and tell you this story is a large part of what they do is very focused on the dividends. Now, they're not chasing dividends either, and they're not just paying out the dividends, but what they end up paying out to family members is based in large part, based on some formulas, you can read that in the paper, from dividends. And one of the points that Jim Garland makes in this paper, and it's kind of really resonated with me, and it gets back to why I think tracking dividends is so important. And there's really two reasons. The first, as he mentions in this paper, is that dividends come from a company's profit. So often I think it's easy to think about our investments as just tickers on a computer screen, digits, numbers on a statement. But behind every ETF and mutual fund or individual stocks, if you invest in individual stocks, are real companies. We actually own real live, operating companies, and they make, hopefully, a profit. And from that profit, many of them, not all of them, but many of them pay a dividend. And that's one of the benefits of being a shareholder, of owning parts of a company. And I think realizing that and seeing what those dividends are kind of brings us a little closer to the actual businesses that we own And I think that can be very valuable. I think the more we can think about the investments we own as real, actual businesses, which is what they are, the better. But there's another reason why I think tracking dividends is important. And actually, I'll come back to this paper because it's a point he makes. Let me move to, this is page 15. This is the stock market. He's just using the S&P 500. Since the 1950s, as you can see here, up until a few years ago. And you'll notice he's tracking three things. Let me see if I can make this just a tad bigger for you, maybe. There we go. He's tracking three things. The green line here is the market value. You can see, as we know, it goes up and down. And sometimes, like here in the 70s, it goes down a lot, went down a lot in the early 2000s, 07, 08 went down. He doesn't have, I don't think this goes quite to 2020 when it fell during COVID. And so that's the value. And as we know, it goes up and down. And sometimes following that, as an investor, can be very nerve-wracking, particularly, by the way, for those of you like me that are kind of, in the retirement stage. You see the stock market drop by 10 or 20%. It's like, oh my goodness. The dotted line are earnings. That's the profit of the companies. And you can see that's pretty volatile too. You can see here, it really tanked in the Great Recession. My goodness. But even, it's normal for profits, earnings, to go up and down as we go through economic cycles. The third line, you probably guessed it, is dividends. Now, dividends are not without volatility. They do go up and down. And we're going to look at another chart in just a minute to show you that. However, they are far more stable or less volatile than either earnings or market values. Why is that? Well, I think there's a couple of reasons. One is companies that pay a dividend really go out of their way not to cut it. They realize if they cut that dividend, that's going to signal to shareholders that there are problems, and they're working very hard not to do that. I think that's one of the reasons dividends are less volatile than earnings. And I think they're less volatile than price because so much affects price, as we've seen. Interest rates go up and down. Some politician says something, the Fed says something. Now, these things can affect business, and they in turn can affect earnings and eventually can affect dividends. So again, I don't want to suggest that dividends don't ever go down. We'll see in just a minute that in fact they do. But they are far less volatile than the prices, the values. And so you put those two together, the dividends really show us, look, we're investing in real companies that are making and selling real things, earning hopefully real profits, and from those profits, paying dividends that we can actually use. Now, I think tying that together with the fact that dividends are less volatile, I think it's a very good thing to track. And as I'll show you, it's very easy to do. It's not like this is going to take a lot of time. And there's a couple of different ways to track them, manually or with some tools I'll show you. So I'm starting to do that now. And I'm actually going back to, I think, at least 2021. I might go back to 2020. And I'll explain how I'm going to do that. Now, in just a minute. The one thing I want to caution, though, there will be times if you say, yeah, I like this idea, Rob, I'm going to track my dividends. There are times when they'll go down, particularly on an after inflation basis. Dividends aren't guaranteed. And in fact, Jim Garland in this paper has an important chart. Let me show it to you. Here we go. He calls it the 4 dividend potholes. These are real. So in other words, after inflation. But they're pretty significant. In the 20s, big drop. And then, of course, we have after the during the Great Depression. And this you can see this one, my goodness, 31 to 55 on an after inflation basis, quite a drop. And then, of course, for those of us like me old enough to remember the 70s, that was no fun. Stock market down, inflation, recessions, long lines at the gas station. Anyway. So difficult there. And then, in some respects, it makes what he calls the 09 to 2012 dividend pothole not look too bad, although it is pretty deep in a very short period of time, not like these back here. But I want to stress that, there will be times when dividends go down. And so I think it's good to know that. And because I think it's just good to set expectations. And so this is, dividends aren't guaranteed. We should keep that in mind. And that's why I showed you this chart. Again, I'll link to this document below the video once we're done. So then that raises the question, all right, how do we actually do this? And so there's a couple of ways. Manually is actually quite easy. And frankly, the easiest is with taxable accounts. Why? Because you get a 1099. They send you your tax document at the end of the year that shows you dividends and interest. So you can just log into your accounts, go to the tax wherever you can get your tax documents, and go back however many years you want. Or maybe you've kept them on file, and you can just go back and add up dividends and interest. I'm going to just do it by year. I don't need it to break it down per transaction or anything. And so that's easy to do. And then for retirement accounts, you're not going to get a 1099 on that. That the dividends and interest, say inside an IRA, for example, aren't taxable. But you can just log into your account, whether it's a 401k or other workplace retirement account. And you might have to, depends on the broker or where it is. I know at Fidelity, I think you have to add them up. I don't know if they sum them for you. Schwab does. So there could be some differences, but literally you should be able to get a whole year's worth of dividend and interest and know what you earned, inside of 15 minutes. So very, very quick. Now you can use tools. I'll show you one and mention a couple. We talk a lot about Empower because it's a tool I really like. And I'll show it to you. There is a trick to this one. So for those of you that use Empower, used to be called Personal Capital, you need to know this. So this is a demo account that I show you guys in the past. I've actually connected one of my IRAs to this account. This actually holds a tips fund. So, but it's the same principle. And I would always go to banking and then cash flow. And you'll notice here there's nothing. And that's I'm going to show you why in just a second. But the thing about cash flow, if you use Empower not only for investments, but also budgeting, and you want to know just your dividends and interest, you can come in here. I don't have many accounts here because this is a demo account, but if this were my real account, you'd see my bank accounts, my credit cards, and all that. I can just say, you know what, I don't want all accounts. I just want my investment accounts. Now, by the way, it turns out in this demo, they're all investment accounts. That's why they're all lit up. But you could limit it just to your investment accounts. But you'll notice even when I do that, even if I go back, say the whole year, nothing. What's going on? Well, by default, Empower excludes from cash flow dividends and interest, the idea being that a lot of people only want to use this for budgeting purposes. And if you're not retired, you're not spending, I would say generally, this is true, you're not spending your dividends and interest. So by default, they don't include it here. But if we go into settings, right here is, whoops, where'd it go? Here it is. Exclude investment income, dividends, and advisory fee from cash flow and budgeting. Let's untick that and save the changes. And then if we go back to cash flow and we go to this year, should show up. There it is. That's my interest from this one IRA. Now it's reloading, but it'll show it to me. I can look at this year. Let me refresh it. There we go. Move this over. Go back to one. I'll go to 1 year. Look at, actually, I just connected this account just for this purpose, by the way. And notice it pulls in data all the way back to 2022. So that's pretty handy. And you'll notice also December is almost always a big month for dividends and interest for funds. But so this is one easy way to do it. If you don't use Empower, but you use another budgeting tool, I can tell you, and I'll give you links below the video. Quicken, you can track all this in investments in Quicken. Quicken or Intuit has another tool that I like a lot called Simplify. It started out as a mobile app budgeting tool, but now they've expanded. There's a web version of it as well. These tools are not expensive. I think Simplify is a few bucks a month, but you can now track investments and Simplify. That's actually just a new change. And I tested it, and sure enough, you can see all your dividends, for any accounts that you link. So probably just about any budgeting tool can help pull all this together for you pretty quickly. So a lot of different ways to do it, but I've really come to believe, and I'm going to start tracking the dividends, even for someone who I don't call myself a dividend investor, but I think it's just another step that brings me closer to the fact that I own Apple. I'm an owner of Apple. And I want to act like an owner of Apple. Not that Tim Cook is going to take my calls, or that I can, direct policy there, which might include maybe raising the dividend, possibly. I don't know. Concerns me they're buying back so many shares at high prices. In any event, I'm still a business owner, and so tracking those dividends keeps me closer to that reality. But I also think it's in one way, it's arguably a better measure of my portfolio as a whole and its performance than the stock price or the fund price, which can swing up and down wildly, as we know, in a day, a week, a month. In some ways, I think the dividends and the interest show us more of sort of the business reality of our investment. So there you go. That's my my video for today. Let me dive into the chat and see. Go back, come out. For some reason, I can't show you the chat today. I don't know why, but I can read your questions. And let's dive in. First one is, should we bother with tracking our portfolio? Does that encourage action? Is blissful ignorance, once you have a diversified investment approach, the best policy? It's actually a great question. And I think the answer for me is it's going to vary from person to person. I keep an eye on my portfolio all the time, and I'm about as I'm about as inactive as one can be. But I certainly agree that if tracking your portfolio regularly is going to worry you, or you just rather not even think about it and just ignore it, I don't disagree with that at all. I would wonder if maybe tracking it and just coming up with these numbers once a year, which I think is plenty. You know, you don't have to do this quarterly or monthly. You can, but you don't have to. I think just tracking it once a year would be reasonable. But yeah, if it's causing you stress, I probably wouldn't do that. So let's see what else we've got. Carson says, I have wondered what I should be looking for in the monthly statements. Also, should I print statements and keep until the next statement comes out as physical proof of assets? I think that's a smart idea. Particularly, you know, if you get them electronically, which I tend to do, you can just save them. You don't even need to print them. You know, save them on your hard drive. Or yeah, you could print them, and I print them and put them in a blue binder. By the way, this isn't all statements. I wish that were all just investment statements. It would be pretty sweet. It's not. So I do think having that in some form is a really smart idea. I have to answer this question because it's a good one, although it's not directly related to the topic. And by and large, I do keep the questions related to the topic. But I like this question a lot. It's from Brad. He says, have you ever come across anyone, say in their 70s, that actually tried to predict and optimize their RMDs, required minimum distributions, through Roth conversions when they were, say, in their 50s or 60s? And how did it turn out? I have not actually. I don't know anyone who has done that, you know, in that set of circumstances. And so I kind of wonder. I will look for someone like that. And by the way, if for those that watch this video, if that describes you, leave a comment below the video. It'd be great to hear what you know, how you did and what your experience was like. Mary mentions my tracking spreadsheet, and I will link to it below the video. Actually, if you just Google investment tracking spreadsheet, it comes up in two places, doughroller.net and robberger.com. They're basically the same spreadsheet. And I'll go to the robberger.com version. And if you click here, it'll ask you if you want to make a copy. Let me just make sure this works. Yeah, here it is. I actually tried to see if I could modify this spreadsheet. We go to the holdings tab to include in here the dividend yield of the investments. And Google Finance, let me make this maybe a little bit bigger for you so you can see it a little better. By the way, this spreadsheet's free. So, you know, if it's helpful to you, by all means, please use it. Google Finance, which I use to generate a lot of these values, even the name of the fund, if we look at what's actually in that cell, it's pulling up a Google Finance function that uses the ticker symbol over here in the B column to pull up the fund's name. They have some Google Finance functions for yield, but they only work for certain types of investments, and I just wasn't having any luck incorporating yield consistently into the spreadsheet. Maybe if someone else knows how to do it, they can let us know, but I was not able to do that. James says, Rob is pivoting to a dividend YouTuber. Nah, not really. But I like my dividends. I mean, who doesn't like dividends? And, you know, I think it's okay to get excited when you see a dividend payment come in, whether you're spending it, whether you're reinvesting it. I think that's a good thing. Why not? All right. I think that's about all the questions related to, well, here's one. Let's see. Would you say that tracking cash flow is more succinct? Well, tracking cash flow, depending on your investments, I assume you mean something like free cash flow from a company. If you're investing in individual stocks, I think there's probably some value in that. And you could use tools like Stock Rover would probably do that. I actually think I linked to that below the video. It's just part of my standard links below videos because it's a tool I've experimented with. Would do that pretty easily. With funds, I don't know how easy that would be. Morningstar might have that data. It actually gets into some bigger issues. So the paper that I showed you from James Garland, the point he makes in that paper is this: you can't take just the company's earnings and spend them and expect your investment pool to last, indefinitely, because that will eventually cause the value of your fund. In this case, it was for the benefit of the family of the Jeffrey and Company. You're effectively overspending, and it's eventually going to bring the value of what you can take out of the fund down. And there's reasons for that. Part of that is that a company needs to reinvest some of those earnings just to maintain their current business. They got to replace. UPS has to replace its trucks every now and again, and energy company has to replace the power lines or their drilling equipment or whatever. So you can't really use earnings. On the other hand, you probably can use more than just dividends, because dividends tend to be too low. You can actually spend more than just the dividend and still keep, your investment fund intact for future generations in the case of Jeffrey and Company, or for future academic studies in the case of an endowment fund. And so the question that he's answering in that paper is, okay, well, it's got to be below earnings, but it can be above dividends. So where is it? And he does two different formulas. I think for you and I, the easier of the two would be to focus on dividends, because it's simply 130% of dividends. And you can read the paper to figure out sort of the logic behind it in his research. If you're coming off of earnings, it's 65% of earnings, but he goes back 15 years to adjust for inflation. And yes, you can already see it's getting probably more complicated than most of you are interested in, certainly more complicated than I care to dive into. So that's diving into the paper a little bit, but again, I'll link to it below the video as soon as we're done here, and you can check it out if that's of interest to you. Again, I don't know how much that applies to sort of the typical retiree who may not want their money to last forever. They'll just be happy if it lasts 30 years, let's say, right? But if you thought, no, I'm kind of interested in intergenerational wealth, if that's you, I would definitely recommend the paper. I think it's at least one approach to that question. So Mike says, I've got a large chunk of funds in a 401k. There's nowhere in the interface to those funds that gives dividends. That's interesting to me, Mike. I would think it depends. I don't know who the administrator is, but I know, like at Fidelity, for example, I have a 401k there, and I can go in, I can look at the transactions, right? Because I'm reinvesting the dividends in my retirement accounts, and it'll show me here, dividend came in, and we reinvested it and bought these many shares of VTI or whatever it happens to be. I gotta believe, Mike, that somewhere that transaction level data has to be available. Now, it may not be available on the website. I wonder if it's available in the statements. If you don't see it there, I would call them, because they've got to have it, right? I mean, they've got to have it. So let's see. Another question, can you elaborate on the pros and cons in the context of rates, such as high rates currently and taxes, considering this will be in a taxable account? Well, so I'm not really factoring in interest rates or taxes per se. They're obviously, interest rates are going to affect the value of assets. They're going to affect the yields we get on bonds. Obviously, taxes, affect just about everything. But I'm thinking about this just on a sort of a pre-tax basis before we even worry about that sort of thing. What are your dividends? What are your interest? And again, our focus was mainly on dividends today, but I think interest too. I would factor in both. That's what I'm really interested in terms of tracking. By the way, not much different than tracking values. I suppose one could say, don't track values, track after-tax values, because in a retirement account, traditional, for example, you're going to lose 20, 30%, whatever it might be, to taxes. You could track the after-tax value. That's certainly reasonable. I tend to just track the value, and in the back of my mind, I know it's not all mine. But certainly in terms of dividends, I'm just sort of focused on before taxes, and certainly not thinking about interest rates per se. So let's see if we got any others before we call it a day. I think that's about it. Oh, here we go. One more. So this is kind of related from Beck. If I'm allocating my investments across taxable and retirement accounts, is it better to hold a dividend-specific fund like SCHD? And here we go. We're talking about dividends, right? In a taxable account or Roth? Well, because it pays out dividends, you're going to have taxable income every year, and probably more taxable income than if you just held it's sort of a total U.S. stock market fund, because SCHD, which is a Schwab dividend fund, and I own it, by the way, full disclosure, I own shares of SCHD. It's going to pay more in dividends than, say, just a U.S. market fund. Now, they're by and large going to be qualified dividends. And so the tax hit may not, depending on your circumstances, may not be that significant. In theory, you could be in a 0% capital gains tax rate, although I'm guessing most people probably aren't. In my case, I hold it in a Roth just to shield it from taxes. I would not be in a 0% capital gains tax rate. And so that's been my choice. But also, a lot of it depends on all your other investments. I mean, you may have, some investments, you can only put so much into a retirement account. And so whatever's left is going to end up being intaxable. And so, part of it depends on what's your best tax efficient approach. And it could depend on what other things you own. So I wouldn't call putting SCHD in a taxable account some awful mistake for most people. But I think my preference is to have it in a retirement account. So Stephen said, I think you skipped my question about holding cash in early retirement for buying dips. That's primarily, Stephen, because I'm kind of keeping the questions limited to the topic. I do a live Q&A. It's usually every other week. Actually, it's going to end up being 2 weeks from this upcoming Monday. And happy to answer those questions. But I will say that by and large, I don't tend to hold a lot of cash for buying dips, because I don't know when dips are happening. I certainly know when the market's gone down 2%, but I don't know if that's a dip. Maybe that's just there's a cliff and I've just come down a few steps, and in 4 days it's going to be a sheer cliff drop. I don't know. I don't know if it's a dip, until 10 years later. So I don't tend to hold a lot of money for dips. Mike, you're welcome. All right. I think that's what we've got for today. Like I said, I will drop a link to the paper below the video here in just a second. And again, to do a live Q&A, it's usually every other Monday. We had one last Monday. The next one's actually going to be 2 weeks from this upcoming Monday. Happy to tackle any questions you have. So hope this has been helpful. Let me know what you think in the comments below, and have a great weekend. Until next time, remember, the best thing money can buy is financial freedom.